where is your percentage of net credit sales method? Any thoughts, any questions with that method? I'm going to take the same problem, modify it a little bit, and show you percentage of AR. Percentage of accounts receivable. And same thing, 20. And can you once again change that, my error there? Year 2010 is the first year of operation. Can you change that? 2010 is the first year of operation. This was percentage of net credit sales number. And here is my percentage of AR method. Basically the same problem, modified a little bit, percentage of AR method. Net credit sales was how much? 2010. Was it 200? Would you debit AR, accounts receivables for 200? And sales revenue for 200. No difference. Done. Now, come December 31st, the company wants to create allowance for doubtful accounts at the rate of 4% of net, 4% of AR. And my AR balance year end is 80,000. And here's the difference between the two methods. And the problem assumes that this is the first year of operation. And you can do it however works for you is fine. Allowance for doubtful accounts, okay? If it's the first year of the company's operation, what do you think is the beginning balance in that allowance for doubtful accounts?
Zero.
Would it be zero? There's nothing there, right? It's the first year of operation. Correct? The company wants to create allowance at the rate of 4% of AR. This is what it means, 4% of AR method. That after everything is done, I want the allowance balance to end with a given percentage times year and AR balance. I want my allowance account to end with that balance, which is 4% in this case times AR 80,000. I want my allowance to end up with 3,200. The normal balance for allowance is at credit. It should end up with a 3,200 credit balance. My beginning balance was zero, right? Were there any write-offs the first year of 2010? There were no write-offs, correct? In 2010, there were no write-offs. So if I'm just gonna, there were no write-offs, correct? What is the balance before year-end adjustments? Before year-end adjustment, before my year-end adjustment, is it zero? Are you with me? I'm developing this chart for you that you can use it for later years also. How much new allowance to create? How much would I new allowance to create? So that I end up with 3,200. Would I create the allowance by 3,200? If I credit that account by 3,200, would I get my ending balance of 3,200? Got it? So I'm going to create an allowance for 3,200, December 31st. Bad debt expense, 3,200, and allowance for doubtful accounts, 3,200. Good. Now come 2011. Jan the 4th. Did you write off David and Company to the extent of 3,000? That journal entry under the two methods is exactly the same. You debit allowance for doubtful accounts, 3,000, and credit AR for 3,000. Exactly the same, no difference. August the 15th, you reinstated able to the extent of $500. Debit AR 500, credit allowance for doubtful accounts 500. Then you collected 500 from able, debit cash 500, credit AR 500. Those entries are exactly the same between the two methods. Clear up to this point? What questions? No difference between the two methods, those transactions. Now, come year end, the company wants to create allowance at the rate of 4% of AR. They believe 4% of AR is a fairly good estimate. They want to stick to that. So how much new allowance will you create in this was for 2010, 2011. Allowance for doubtful accounts is a permanent account, balance sheet account, right? Last year's ending balance becomes this year's beginning balance. What's my beginning balance? Is it 3,200? It's a credit balance of 3,200. Right? Last year's ending balance, this year's beginning balance. You can also do it in a T account format. Whatever you're comfortable with, fine with me. Did you write off something in 2011? You wrote off able to the extent of what? 3,000. You debited a allowance. You debited allowance. You reduced allowance by 3,000. Did you reinstate something of able? Did you reinstate able to the extent of 500? Did you credit allowance for 500? What is the balance before adjustments? What is my balance before adjustment?
700.
Is it 700? Is it a credit or a debit balance? The credit balance, you better pay attention to that. It's a credit balance. How much you want the allowance to end with? Is it 4% or what? Is it 90,000? Would it be 4% of 90,000? Would it be 3,600? You want the allowance to end with 3,600. How much do you already have in the allowance account? 700. How much new allowance to create? How much new allowance are you going to create?
2,900.
You said 2,900? If you credit this account by 2,900, will it give you the ending balance for 3,600? So you need to know how much is in the allowance account before your adjustment is made, and determine how much new allowance to create to end up with this desired ending balance. This is how percentage of AR works. This is the difference between percentage of AR and net credit sales method. That you say, okay, my allowance account should end up with 3,600. How much more do I need to reach that balance? What do you think would be your year-end adjusted interest? Let me complete a couple of steps and then I'll open the floor for questions. Was it 2,900? And the allowance for doubtful accounts. Good? Do you see the difference between the two methods? The process as to how much allowance to create, that is different. Now, if I were to prepare a balance sheet, 2011, under percentage of AR method, what's my accounts receivables balance at the year end? Did the problem say 90,000? What's the balance in my allowance account? In this case, is it 3,600? Are you with me? The net receivables will be 86,400. The net receivables between percentage of AR and percentage of credit sales will be a little different, because the approach to creating allowance was different. The company has a choice to use percentage of AR or percentage of net credit sales. Whichever gives them a closer estimate, they will use that. But both are acceptable approaches. And if they choose percentage of AR, they need to use that method consistently from year to year. They cannot go back and forth. If they're using percentage of net credit sales, they are required to use it consistently from year to year. Fine. Can I erase this part of the board? I want to show you something else. Let me erase this part of the board. Let me hypothetically change the numbers a little bit. I'm looking at 2011, okay? My beginning balance was how much? I'm looking at percentage of AR. Percentage of AR. Okay. My beginning balance was how much? Was it 3,200? Are you with me? This is the credit balance. My write-off. last time we wrote off 3,000, correct? Can I say that we wrote off, let's say hypothetically, we wrote off 4,000 of April. We wrote off 4,000 of April. Okay? Let's, instead of 3,000, we wrote off 4,000 of April, hypothetically. And then we reinstated April to the extent of 500. Okay? Now, what is my balance in AR? Balance before adjustment. Before my adjusting journal entry. Somebody help me out. Is it $300 debit? Somebody help me out. Is there a deficiency in that account of $300? You need to pay attention to this balance. Now I have a deficiency in my allowance account by 300. If I want my year-end AR allowance to be, if I want my year-end balance to be 3,600, and I want my allowance to end with 3,600, how much new allowance will I create?
3,900.
Would you create 3,900? So after this 300 is absorbed, am I left with 3,600? So if you're looking at percentage in AR, you gotta pay attention to what's the balancing allowance before the year adjustment is made. If there's debit balance of 300, that means there's a deficiency of 300, you're gonna create the allowance by that much more, so that the 300 deficiency is absorbed, and then you're left with a balance of 3,600 credit in that account. In the prior example, you had 700 credit in that allowance account. The allowance account still had $700 in it. In that case, you create by that much less to reach the desired ending balance in allowance. So know these two methods thoroughly. You're going to be tested quite a bit on these two methods. And when you come to next class, I'll give you a quiz on these two methods. Your homework to be done for these two methods? Quiz. Okay? If I don't get to know the receivable, if I have time, we'll do it. If we don't have time, let's skip. But I want to cover some major topics in that. So here it is, 4% is AR. You have your beginning balance. You need to determine balance in allowance before your and adjusting G. Determine how much is in the allowance account, and then determine how much new allowance to create to get to the desired ending balance. Good? Under the direct write-off method, no allowance for doubtful accounts created. There is no allowance. There is no advance provision for accounts that may go bad. You write off an account when an account goes bad. Nothing is done ahead of time. If you look at this example that we were looking at, If you look at this example that we did, and if you were to use the direct write-off method, in 2010, did you write off an account? Was an account written off in 2010? There was no account written off in 2010. So in 2010, if you looked at the same example and did the direct write-off, 2010, no JE for write-off. You will do the other journal entries to report credit sales, collection on account, and all that you will do. But there is no journal entry for write-off because nothing was written off. And there is no allowance for doubtful accounts created. You don't create, there is no allowance for doubtful accounts. 2011, did an account go bad? At that time, you will debit bad debt expense. You wrote off 3,000, correct? And credit AR 3,000. As and when an account goes bad, you deal with it. If you reinstated able, you'll debit AR for 500, we just reduce your bad debt expense 500, and then debit cash 500, credit AR 500. No allowance is created. Both percentage of net credit sales, percentage of AR, they are in accordance to GAAP. Either of those methods is in accordance to GAAP, generally accepted accounting principle. And the reason for that, because they conform to the matching principle. They conform to the matching principle. That means if you recognize revenue for 200,000 in a given year, the cost of doing credit sales is also recognized in the same accounting period. You don't know exactly who will not pay, but based on an estimate, you create an allowance. So I recognize 200,000 credit sales. Some of that will not be collected as a cost of doing credit sales. I recognize that expense in the same accounting year. Therefore, I get the correct amount of net income. But if I use the direct write-off method, I can recognize all credit sales 200,000 in 1 year. My cost of doing credit sales is recognized in another year. I mismatch revenues and expenses. Therefore, the direct write-off is not in accordance to GAAP. It does not conform to the matching principle. Okay? Any thoughts, any questions? These two methods and a bit about direct write-off method leadership. These are very important concepts in accounting. And maybe next class I can show you the relevance of this concept in what's happening in today's accounting profession. Need to come over the science of these topics. If I haven't done notes receivable, you can skip notes receivables for the time being. Good? If there are problems regarding notes receivable, you can skip that for the time being. You can put everything aside.